GST is really the mother of all economic reforms. It's a big reform in the making, and it's finally going to become a reality, hopefully on the 1st of July itself. But the fine print, the devil always lies in the details. This is a reform that is going to undo the indirect tax burden for India Inc. What are the questions that Indian industry has? And who better than one of the key architects of the GST, Mr. Hasmukh Adhia, India's Revenue Secretary, joining us right here on ET Now on a very star-studded panel. We've got Mr. R.C. Bhargava, Mr. Pawan Goenka, Mr. Mariwala, Deep Kalra, Naina, Kidwai, Rajiv, Memani, and we've got questions pouring in from Indian industry. We've got questions from DLF, we've got questions from PVR, capital goods, and all of that over the next 55 minutes or so, or should I say an hour. Thank you very much, Mr. Adhia, for being with us. And I'm the moderator, so I'm just going to take the privilege and ask you the first question. GST was supposed to be this one India, one tax. At the end of it, it seems like it's one India and 8 taxes, 4 for goods, 4 for services. Your critics say this is a cumbersome exercise. How are you going to defend it?
It's not, it's still one India, one tax. The idea of one India, one tax is that if you're buying a refrigerator, the rate of tax on refrigerator should be the same in Arunachal Pradesh, in Tamil Nadu, in Gujarat, in West Bengal. That's the idea, and that remains.
Fair point indeed. I will also ask you a second question, and that has to do with some, by and large, you've kept it anti-inflationary. By and large, you've kept the rates of goods and services to rates where they were. But for cases where services rates have gone up, for instance, the finance minister and you have both said the input tax credit should take care of this. How seamless is that going to be?
Well, it is all. We have the entire IT system enabled GST. And for taking an input tax credit, you don't have to do anything. You just claim it in the IT system. So it's going to be seamless flow of input tax credit for both goods and services. And even in the telecom sector, where there have been some headlines saying, no, telecom cannot bear this. Let me explain.
Right.
The 15% service tax which we have now has got 2 cesses also. There is a Krishi Kalyan cess on which the input tax credit is available only for Krishi Kalyan cess. You don't get input tax credit of Krishi Kalyan cess against normal GST.
That's right.
The second is the Swachh Bharat cess, in which case we are giving no input tax credit. So at multiple points in the service chain, they are being imposed again and again without input tax credit. So in effect, it is a turnover tax. So our exact incidence of 15% now is almost close to 16%. Secondly, even in telecom sector, there is a calculation made by us that at least 2.7% is the tax paid by them on the goods which they consume in giving telecom services. So that credit will now be available to them. So virtually there is not going to be any tax increase as far as telecom sector is also concerned. And all other services sector also. On an average, they have some kind of input tax credit for goods to be taken out of services, which is now going to be available. So virtually it will be a neutral exercise. There will be no increase in the actual tax incidence on services also.
Indeed. I will have a quick question and then I will throw it to Mr. Bhargava to begin this discussion with. And this question has to do with anti-profiteering mechanism. You have said that you will take care that benefits are passed on, and if that doesn't happen, you are going to scan the books of Indian industry. Is that being a little intrusive? And how concerned are you that you will perhaps have to invoke that anti-profiteering mechanism?
Well, I am quite concerned about the interest of the consumers also, because when there is such a big shift in the taxation system, it's always possible that few players, they try to fleece the customers by saying, no, the headline rate has gone up, so I'm going to charge you more. Now, this is something, most of it we want to take care of by way of consumer education. But then still, if it has to be done, it has to be done. So if there are few industries, particularly the top ones, the big corporates, who try to sort of increase the prices of their commodities, even when the actual tax incidence has not gone up, we may have to look into it, unfortunately.
Okay, I'm going to get Mr. R.C. Bhargava, a senior statesman from Indian industry and also with his fingers in the auto pie. And auto has been a sector, and we've got 2 of the tallest leaders, Mr. R.C. Bhargava and Mr. Pawan Goenka, joining us to take on questions. Mr. Bhargava, it's all yours.
Thank you. Mr. Adhia, I must congratulate you on the rates which you fixed for the automobile sector, because they are so close to the existing tax rates that what you just said about prices not changing is going to be, I think, a reality. There's one area where there is a little amount of, let's say, doubt in our minds. We are not clear what is intended, and that is for hybrid cars. Today, hybrid cars are taxed exactly like small cars, 12% excise and then whatever VAT states impose. In the new system, hybrid cars are not mentioned under the GST classification at all. But in the cess side, hybrid cars have 15%. Now, it's not clear to us what is the actual tax which will apply to hybrid cars compared to today's 12% excise, 12.5% excise duty plus state VATs. So if you could please clarify that, I think one only area of doubt actually would disappear.
Okay. As far as the hybrid cars are concerned, what we have done is to divide them into two parts. So when it comes to smaller hybrid cars, on which we have put some cess, those smaller cars, those varieties of smaller cars, there we have said that we are not going to charge any cess on hybrid cars. So there is going to be a distinction between a normal small car, which will attract a cess of 1% or 3%, depending on petrol or diesel, and other hybrid cars where there is only GST of 28% to be paid. There is no cess on small hybrid cars. So that is one thing I want to make it very clear. As far as the bigger variety of hybrid cars are concerned, on which there is a 15% cess being attracted now under the present, we have said 15%, no, or 12%? 15%. So that cess will apply to both hybrid as well as non-hybrid big cars. So as far as big cars is concerned, the council has decided to keep no distinction because these are all bigger cars, and probably the council feels that the incidence of cess can be borne by those people.
So it would mean hybrid car, bigger hybrid cars will get total of 43%, 28 plus 15, against today's roughly 28, 29%. It'll go up by about 14%.
I don't know how do they calculate, but yes, a lot of shift was happening in case of hybrid cars, which are actually more expensive than the normal big cars also, where there is an additional engine and additional provision to be made. So that's why in that bracket of price, probably the consumers could afford, that cess, additional cess.
Well, that's a very important clarification that at least in the high-end hybrid car bracket, consumers will have to bear a higher tax. But let's take this across to Mr. Pawan Goenka. Again, somebody's got a huge exposure in the Indian auto space, has a couple of questions there. Mr. Goenka?
Thank you, sir. This is Pawan Goenka from Mahindra. First of all, on behalf of the industry, I must compliment the GST Council for reaching convergence. I can imagine it won't be an easy thing with so many different lobby groups from industry as well as states working on it. So it was a very good task and very difficult task to have completed. My only first request will be that the July 1st date, as the government is saying consistently, should be maintained now, because now that the rates are announced, we will start working on managing everything around July 1st date, and there should not be any slippage to that date. I have a couple of questions. One was on the excise or the GST on the hybrid vehicle, which Mr. Bhargava has already asked and you have responded. So thank you for that clarification. My concern is more on the transition right now than on the GST rate, because for the auto industry, I think Council has done a very good job in ensuring that almost in all the different classifications that we have, except for hybrid, large hybrids now, the GST rate is equal to or maybe slightly lower than what we are paying today. But in the transition on the auto side and tractor side, I have some concern. First, taking tractor. As you know that tractor today have no excise duty, and therefore we will not get, as per the current regulation that has been put out, any transitionary credit for the stock that is in our stockyards or with the dealers. Now that is a fairly big concern for the industry, with 65,000 tractors that we will have in stock as on July 1st. And similarly for auto, we will have as many as 4 lakh passenger vehicle in the industry that will be in stock as of July 1st. And from the current rule that we have, we will only get 40% of CGST as a credit, which is a very small amount given that the excise duty on many of these vehicles will be as high as 32%, and the 40% of CGST comes to only 5.6%. So I request some clarification and some consideration on these two.
Well,
Right.
well, yeah, if you have seen, there are
Go ahead. Sir.
there are 9 rules which we had put in the in the draft regime, and out of which 7 are finalized by GST Council. One of the 2 rules which is not finalized is the transition rules, in which this 40% provision comes, what you are talking about. The law committee has got a lot of representations from the industry, like you have also sent. So they are looking at it, and they will come up with their final recommendation to the council only on the 3rd of June, and we would be able to finalize it on 3rd of June, and you might expect some relief in that. So let us wait till then. We will take your point on record, and we'll see what best we can do.
Okay, I'm going to ask one more question before I take it across to Rajiv, Memani, and Mr. Goenka. You had another question that we had discussed previously. You'd want to ask that,
Yes.
and I'm going to come back to you as I carry forward this discussion. Go ahead with your second question, sir.
Okay. Okay. So second question is that in many goods there is a inverted tax structure, where the tax on input is much higher than the tax on output. In that case, the concern is that even though we will get a refund, but it might take a long time to get the refund. And I hope that the council will put very clear guidelines so that refund happens reasonably quickly, maybe a couple of months, but not take a year and a half. For example, tractors, for example.
Yes, we will ensure
genset
that,
engines.
but at the same time, let me tell you, yeah, there are very few items where it is happening, where the inverted duty structure is happening. But that also you must appreciate that for the first time in GST we have done it. In the existing VAT regime, it is not there. While in GST regime, we have made sure that you get the entire refund back, So that's a positive provision we have brought in. Of course, refund is a matter of time. But yes, we will try and expedite the refund because everything is online.
All right, so we will have exit refunds as far as the industry is concerned. Let's get in Rajiv, Memani, and I know Mr. Memani has a few questions on preparedness there. Rajiv?
Yeah, sir, firstly, let me add my compliments. I think the way the entire council has operated, and I know you and your team have done tremendous amount of work in following a very scientific process for arriving at these rates. So really my compliments for that. Sir, I have some questions relating to the preparedness overall. And particularly in case of GSTN, I think the GSTN team has done outstanding work of preparing the systems, getting the systems ready. But I think some of the rules and laws have recently come. So if I look at the APIs, which are very critical for the GSTN to function and interface with industry, so a lot of the APIs, for example, APIs today are only ready for GSTR1 and partly for GSTR2. For GSTR3, which is very critical, for GSTR6, which is also very critical, GSTR7, GSTR8, the APIs are not yet ready. And if the APIs are not ready, they are not implemented on the sandbox, it's very difficult for the GSPs to prepare the applications. And that's the only way the industry and the business, especially the larger businesses, will be able to talk to the GSTN system. And in the past for GSTR1 and others, it has almost taken 1 month for this to stabilize. So I think, sir, the industry is a real concern. Plus the various ERP implementation agencies, their patches, SAP, Oracle, Microsoft, their patches will only get ready once the APIs are fully finalized. So I said, sir, this is a big worry and concern. And also for the smaller businesses, they are relying a lot on the Excel feature that GSTN is looking, which hopefully they will use the Excel utility to file in their returns and everything. So they are very keen to find out when will the Excel utility get ready. So that's one question, sir, and then I have a couple of others, but it will be this probably, in my view, the preparedness of GSTN is the most critical issue right now for us to go live on July 1.
Right. So let me just get him to answer your first questions and then you can do your follow-up. Go ahead, Mr. Adhia.
Well, as far as the preparedness is concerned, we are quite on track. I have myself reviewed the state of preparedness of GSTN in various software, and even the GST Council is going to look at the presentation to be made by GSTN about the state of preparedness. But sharing of API, yes, we will do it as early as possible. The only thing is that we are getting constant feedback on the various forms and the return form that we have prepared so far. And there is an industry demand that they can be made more simpler than what they are. So we have actually worked on it, and we might be making some very positive changes and make them, we want to make them very, very short. So as far as your GSTR 1, 2, 3 is concerned. So that work has been completed, and GSTN will shortly inform you about the changes that we are making in order to make them very, very small and handy. So that is a process which is going on, because when we did our beta testing, we found a lot of feedback coming to us. So yes, it's a constant process. We are also making our GSTN work hard. We give them a task, we give them changes at the last moment, and then they are able to cope up with it. So similarly, the industry also, the ERP system providers and the consultants, they should also be in readiness to work over time, and as soon as we share API, they should be able to make the system software for their clients. So we will try our best to do it as early as possible, but it is also in the interest of the trade and industry that the forms we design are not cumbersome. They should be very business friendly. So that's the target.
I'm going to get Rajiv Memani to ask one more question, because I know he has an appointment which he cancelled to be on this show. So I'm going to quickly get him to ask one more question, and then we'll perhaps move on with FMCG. Rajiv?
Yeah, I agree, sir. I agree, but please bear in mind when you look at this that the industry will need, at least 4 weeks for once the APIs are done to get ready, and we are about 5 weeks away right now. So that was one concern. So the other thing was, in the rules and other places, the area-based incentives and others, still it's not very clear. So whilst in principle you have said that a lot of these area-based incentives at the center and at the state level will be grandfathered, but I think it's still not very clear how that will actually play out. And I think that is very critical, again, from a design of the system, pricing and other things, especially in some sectors. And also vis-a-vis SEZs and others, some of the rules, clarifications are not very clear. The kind of registrations, the credit mechanism only works once you are on the portal. So will they have to be, right now they get upfront exemption. Now will they have to get through the GST or 2, they will have to get onto the portal and then get it. So there are lots of issues like that. And is there a way that industry can expect that some of these rules and clarifications will come out very rapidly so that they can prepare for the July 1 rollout, including commercials, pricing and everything else?
Well, as far as your first question is concerned, right in the second meeting of GST Council, if I remember, it was decided that although it's not necessary to grandfather any incentives given for a particular area-based exemption or whatever in the GST regime, because it's altogether a new tax, but still we had left it for the various state governments to decide about it. If they have given any VAT exemption, they will decide for SGST. And as far as Government of India is concerned, the clarity was given in that meeting itself that now that exemptions cannot be given, we have to only reimburse to the people whatever taxes they pay. So Government of India has already decided in that meeting, Finance Minister had assured that whatever amount we get by way of CGST, we will sort of give it back. 58% of it will reimburse to the industry. The rest 42% we cannot reimburse because it is not, it's an amount which is going by way of devolution to the states. So it's not the Government of India money, it is not the money coming to the Government of India. So whatever money we are getting out of your CGST, we would get that back to the industry. That's a clarification we have given, but the DIPP, Department of Industrial Policy and Promotion, has to make a scheme for it. We have written to them. Hopefully they'll come out with a scheme.
I think financial services is a big area of debate, concern, and discussions there. And who better than Naina Kidwai to ask you the next question, sir? An ace banker with the exposure now to the financial services and the insurance space. Ms. Kidwai, go ahead. Your questions, ma'am.
So let me just start by lending my voice to congratulating you, Mr. Adhia, for having brought GST to a stage where we can discuss the nitty-gritties and not just hope and beg that GST were to happen. Really what we have reached today is truly remarkable. My question is really around the whole issue of centralized assessment interface for the service-oriented industries. So it's banking, yes, but also telecom, insurance, and the IT sectors. And as we've understood it, the states clearly are wanting their share of the pie in this. And the compliance in terms of the various levels, therefore, at which the tax would happen is a big worry for the sectors. How do you see this playing out, and how can we ensure that it's not too onerous in terms of the implementation at each state level?
Okay. It's a good question. Of course, this is not the best thing that is happening. I agree. We could probably, as a country, we could have agreed to a single interface, but unfortunately, the states are not on board for that, and that's why we had to have this kind of a system in which individual state registrations have to be done. So, but what is the as far as the compliance burden is concerned, it's a matter of machine designing a system for that, and I don't think there's a manual compliance involved anywhere in the GST process. So if the banks and the insurance companies, they have a good ERP system in which all invoices are recorded state-wise, and then they can easily be converted into returns also state-wise, and so that compliance burden is not on human beings, it is on the ERP systems of the banks and insurance companies. But the major worry that the banks may have is that if their cases are audited by different people in different states, and then if there is a dispute between one state and the other, then what? Now, these are the issues we are yet to grapple with. So, when it comes to the final scrutiny and the assessment, whether we can have some kind of a single interface of each service sector unit with only one committee or one group of people, in which some state people can also be there, central government officers can be there. So the main issue is now how can we save the situation by having a single interface for audit purpose, for the scrutiny of returns at the time of final when the final return is filed. So that's something we are looking at, and we will try and see to it that there is less burden there.
That interface is very crucial. Ms. Kidwai, you'll have a follow-up question, and I'm going to come back to you just after I take more questions from the industry. But I'll let you ask one more question at this stage, ma'am.
Yeah. So I had a question really around the renewable sector, because the various taxes and the way they're going to add up, for example, an 18% I believe on renewable equipment and 5% for coal, whereas as a nation we are trying to move to a large renewables agenda, and how that prices against other sectors that are used for provision of power, for example coal here, are areas which are troubling. So the arithmetic here in terms of guiding India into the renewable agenda which we have embarked on is going to be quite important. So how are we going to address some of these issues as they come up? Because there may be some of these anomalies which arise, because yes, you want to make things cheaper as you must for the poor and in power, but what does it do in terms of pricing on the other side for what we also need, which is the renewable power?
Indeed.
Well, if I have heard it right, I think the Power Minister the other day had said that now renewable energy sector in India is so mature that probably no tax breaks are required for renewable sector. But notwithstanding that, let me tell you that there are no inputs in renewable energy except the capital goods. Now, if the capital goods are there, then we need to also promote Make in India for renewable sector also. So if we have to do that, then we have to have some taxation on the renewable equipments which are used. So that's why even to help Make in India, On the domestic production of the renewable equipments, we need to put some tax, and that's why there is some tax there. As far as custom duty is concerned, there will still be exemption available, whatever is available for renewable sector. But with, if we suppose say that zero tax for renewable equipments, then no renewable equipments will ever be made in India, because the imported goods would have completely no taxes on it, while the domestic manufacturers would have a lot of cascading of taxation happening, which they cannot get. So by putting some tax rate on the renewable equipment, equivalent amount of tax rate will be applied on the imported equipments also. So this will actually help renewable sector.
Okay, I'm just take this across to FMCG, and I think FMCG, while it has reacted in trade and people believe you've brought rates down, Harsh Mariwala has a question on tax breaks that the industry was getting for geographical based investments. Mr. Mariwala?
So I think the industry has made significant investments in northeast and other backward areas for getting exemptions from excise. And I wanted to know, when are you announcing area-based exemption policy, and I hope that they will continue as per the promises made.
So will this continue?
I think I already mentioned it. It is the Department of Industrial Policy and Promotion which will have to come out with a scheme. Number one, for grandfathering the existing exemptions to the extent of 58%, as Finance Minister had agreed in the GST Council's meeting. And second is for, suppose in Northeast, the policy has already expired, so whether to continue or give extension or not, that's a subject to be dealt with by Department of Industrial Policy and Promotion, and I already returned to my colleague there and they are looking at it.
So I'm quickly clubbing a question that came in from Dabur, and the CEO couldn't be here, but they did send in a question. Can GST for Ayurvedic medicines and products be considered at lower than 12% in light of the current tax on these products and the government's focus on promoting Ayurveda?
Well, actually, we are of course, there are a lot of objectives to be achieved by government for promoting this sector, that sector. By and large, we have taken a mechanical view of fixation, fitment. What we want to do is that we want to keep the GST tax rate closer to the present incidence on that commodity. And when it comes to Ayurvedic drugs, we have calculated exactly the present incidence, and it is more than 12%. So that's why it stands at 12%. Unlike some media reports and some tweeters going around that Ayurvedic medicine is at 18% and the other medicines are at 12%. No, even the Ayurvedic medicines are at 12%.
Okay, so Ayurvedic are also at 12%. I will take a quick question that also came in from the cola guys and the guys that you and Dr. Subramanian continues to call sinners. Pepsi actually sent in a question, D. Shivakumar, the chairman and CEO of Pepsi India. And he says 40% tax on soft drinks and all innovative products. This will kill industry and lead to lesser revenues. Why is there no incentive for lower sugar products as well? What is the incentive for low sugar drinks? And of course, he went on to say that tax on soft drink went up by 5% in 2015, 3% in 2016, now 3 to 5%. Isn't this anti-business? Are you milking a cow that will eventually die?
I don't think so. Again, I am telling you, we have more or less taken a mechanical view of fitment. I don't think we have tried to kill any sector by putting an extraordinary rate compared to the existing rate. All we have tried to do is to fit them into the nearest slab. That's all, So we haven't done that, and we don't intend to do that. Yes, it is a sin product, but not sin product, but it's a product which is less desirable from health point of view. That's what people say. But we haven't looked at it from that angle. We have simply done a fitment according to the existing incidence of tax, and I don't think it has gone up very much in that sector also.
So the question that came in from their cousins in Coca-Cola, and they say that for the transitional credit traders, which generally don't hold excise invoice, do you think 40% of CGST alone is adequate for products currently attracting excise at 21% on MRP? GST rate has been fixed at 40%. The transitional credit at 5.6% of the selling price will simply kill the industry.
I already said something about it. The transition rules are yet to be finalized. A lot of representations have come, and the committee will look at it. The committee will come back to the GST Council on 3rd of June. So we will finally make it public on that day, once the GST Council finalizes them.
Okay, I'm going to take this Deep Kalra, and he represents the internet players and the e-commerce guys really. Deep, take over your questions. I think you have plenty of questions on e-commerce, but let's begin with your vertical, online travel space to begin with.
Sir, firstly, I'd like to congratulate you for pushing through the GST for goods and services in record time. I think it's a huge feat, and on behalf of the entire industry, I'd really like to congratulate you on the same. I do have a few questions on behalf of the online industry for travel. The first one really being, sir, around level playing field. If you look at the current provisions, then an online travel agent, when he sells a tour package, an international tour package, it is taxed at 5% on gross turnover. However, when the same tour package is sold by an international operator, international OTA or operator, there is no taxation because the operator is not present in India. This obviously is discriminatory towards the Indian players, and it's requested that this be looked at. Perhaps deemed provision for taxation can be brought in out here, where either an agent will have to be applied, or an agent will have to be registered in the country for that tour operator, or the foreign tour operator will have to be registered in the country, so that there is no discriminatory taxation on the local operators.
No discrimination for the local
Okay.
operator. How do you justify
Well,
that?
when it comes to giving digital services to Indian consumers, we have already done that. Particularly the advertisement, particularly that Netflix type of a service which Indian consumers are receiving. There we have said that even if you don't have any presence in India, you have to appoint an agent in India who can pay it, So that is what we have said as far as that service is concerned. Here the issue is that under the place of supply rules and also under the basic taxation rule, only the companies which are present in India, they can they have to pay service tax on services which are given by them in India. Now, if some other operator is giving services in some other country, that country would be charging them taxation. So it would not be fair for us to tax them here. So that's one. But as far as your point about 5% being charged on the overall package is concerned, you have another option. You can make your actual booking of airline separately, booking of hotel separately, and only on the services that you give, you can pay entire 18%, on the service tax that you take, on the service charge that you levy on the customer. So that's another option available to you if you don't want to pay the entire package, pay on the entire package 5%. So that is an option available to you, and I'm sure the business models will change according to the taxation system. So people may prefer that option also.
Okay, I think Deep Kalra has a follow-up question on the specific e-commerce space.
Yes.
And yes, actually, Mr. Bhargava has a question, so let's go across to him. Yes, please come in, sir.
Mr. Adhia, from what you've been saying, you had a more or less mechanical fixation of rates. But in the case of hybrid cars, the existing rate was 28%. It has been increased to 43%. Is there any policy object behind this, or why? Because hybrid cars are meant for cleaner cars, environmentally friendly cars, and they are being...
in pieces with what your government was talking about, renewable energy, clean energy. So this kind of is an...
The question is that, look, in the entire spectrum of cars, the number of small cars are more in the country. And we definitely, I think it's council. When I'm saying we means not me, I'm talking about council. The council does feel that, yes, in small car segment where more number of consumers are there, where more number of cars are also there. So there, I think we need to encourage the hybrid car, and that's why we have created a differentiation now between the small cars which are non-hybrid vis-a-vis small cars which are hybrid. But as far as big cars are concerned, which are few in numbers, I suppose so, there again, the idea was that probably those segments of the consumers can afford to pay. And secondly, also there would be probably some kind of classification issue or some kind of a issue of people trying to deliberately shift to hybrid car initially. I don't know. But that all those factors were weighing heavily on the mind of GST Council when they decided this. But there could always be a representation, and I don't think these are things.
I was going to ask you that. Given the voices that are coming, are you willing to review?
Yeah, maybe. I mean, the industry is free to always write to us. They've been writing to us. We have been reading their memorandum carefully, and we're willing to take it to the council. We can always.
In fact, small cars, there is no hybridization of small cars because if the tax on hybrid cars and liquid fuel cars is identical, no hybrid car sells because of the price difference. Making a hybrid car is the cost of a liquid fuel car plus the cost of hybridization. And customers don't pay that extra cost of hybridization without this difference. That is why it was done for bigger cars. In fact, the industry is representing that even for smaller cars, a differential needs to be created.
Yeah, but smaller cars now we have created a difference, although it's not big enough.
There is no difference, sir.
No,
because
there
the
is.
liquid fuel cars will have 29%. The hybrid small cars will also have 29%.
28.
28 plus 1, 28, so 1%.
28.
But the cost of the hybrid system, the customer will not pay for a 1% benefit.
No, but diesel car will have a difference of 3%. Yeah.
They won't pay that for 3%. The cost, cost of the hybrid car is much higher.
Is something which can be represented again,
So this is a issue that the government is open on, and I think you need to petition him. Indeed, for the council to decide, and of course, I wonder if Dr. Goenka has a view on this, and you want to join this discussion on hybrid cars, and Mr. Adhia is rather open to the suggestion and is willing to review if there is a petition and that does find merit with the council. You want to lend your voice of support to what Mr. Bhargava is saying?
I think if the council is open to looking at it, it will be perhaps desirable for the industry to make a representation as to why we think hybrid cars should have lower instance of cess or excise duty or GST. Perhaps maybe all the information was not fully available at the time of making the decision. So it will be worth a review because this is the only segment in the auto industry where the rates are going up rather than going down, and therefore a review is perhaps will be useful. If I could just add on my earlier question only just one more thing, that for the auto and tractor industry, sir, this transition is a very high stake game, and because inventories are very large, per unit costs are very large, and the amount of money that we could lose in transition if it is not properly compensated could be extremely high. Now, industry just recovering from the BS3 hit that we had, BS3 to BS4, and we cannot afford to take another hit in the transition to GST. So my request is that this be very properly and carefully taken look at, and also there is an element of cess that we were paying earlier, 4% cess, that is not getting transition credit. That also needs to be looked at because cess is not getting moderated. So this is a very, very important point for both the auto industry and the tractor industry. Like you said, June 3rd, the decision point will be, but I hope the decision will take into account that this is the only major issue other than the hybrid car GST rate that the auto and tractor industry has today.
And you've said you're open to both suggestions at this point in time.
This decision, yes, it is under discussion, and we will bring it to council on 3rd June itself.
Okay, Deep Kalra had a question on e-commerce there, and let's take this across to Deep, please.
Under the current provisions of the GST, all suppliers, no matter how small, have to mandatory take registration and come under the tax net. While this is a very good thing, but this also means that micro suppliers and micro players who have a turnover less than 20 lakhs will have to mandatorily register themselves on online players and e-commerce players. Now, this could discriminate against the online players because while selling on an offline player or platform, there is no need to take any registration. So, it is requested that this provision be looked at. Thank you.
Well, I don't think there is a distinction here. If you have seen the other provision, just as you are saying that for a person to be connected with a e-commerce operator, the vendor should be registered. Similarly, on the other side, for offline also, there is a provision that if a registered dealer is buying any goods from unregistered dealer, then there will be a GST incidence in the reverse charge on the registered dealer. So virtually, it is the same. The compliance burden will not be on the small trader, but ultimately the GST will get paid to the government. So this is something which is common to both. And the idea behind this also is that you need to, somebody needs to pay the GST on whatever supplies are made.
Okay, I have a quick question on real estate, sir, and the CEOs are not here, but I got in questions from both the Hiranandani group, Mr. Niranjan Hiranandani, and Rajiv Talwar of DLF. I'm going to club in both questions. From DLF, they say, as per entry number 19, the cost of construction, including land cost and input credit, falls under 12% service slab of GST. But this is only for sale. Are rent-yielding assets not covered? And can you just clarify on this?
Well, this 12% rate is what we call works contract rate. So,
That's right, yes.
if you are buying your flat or apartment or a bungalow in advance and then you are making payment by installment, then that is called a works contract. So, on works contract, the rate will be 12%. But the benefit that we are now giving is that you can take the input tax credit of all the building material that have gone into making of that apartment. So for cement, steel, sanitary products, glass, aluminum section, whatever fittings, electrical fittings, and most of these items are attracting 28% of tax. So all those items would be available for input tax credit. So in fact, in real estate, the flats and apartments which are being constructed should have lower incidence. In fact, we have to also make a provision that if the credit overflow takes place, which is likely in real estate sector, because all the items of input tax credit are 28% item,
yes.
this is 12%. So we have said no credit inflow, credit overflow will be given. So that we have to do. So on the whole, in the works contract, in the real estate sector, the consumers will be benefited.
Also, one more question in real estate, and this kind of puzzles me also. High stamp duties and municipal development charges have not been subsumed into GST. This will make affordable housing expensive, especially in urban areas. Shouldn't the aforesaid charges be subsumed within the GST? And of course, then the demand is, can affordable housing not be exempted like education and healthcare? I'm not asking you that question, but I'm asking you the previous question.
No, there is a distinction between taxes and the user charges which are taken. So if the municipal bodies are charging anything for passing of the plan or for giving completion certificate or whatever for site supervision, these are user charges. We can't club user charges with the tax. Those remain.
Okay, so the user charges and tax remain. I also have a very quick question from the capital goods space, and this comes in from Blue Star because I think there's a big impact there. The work related to buildings such as air conditioning, electric and plumbing works contract GST is 12 or 18%. If a large air conditioning equipment for a building is sold, it attracts 28% GST. If it is sold as supply, installation, testing and commission, it attracts 18%. In this case, input GST is higher than the output. Does this not amount to an inverted duty structure?
But even if it is inverted duty structure, you would normally get refund in other industry.
That's right.
But in works contract, we have said that no credit overflow will take place, So that is because we have made a very subsidized rate of 12% on works contract. We didn't want the real estate sector to be hit, badly.
That's
so
right.
the rate is subsidized. There will be no credit overflow, but they will get entire credit, for whatever inputs have gone into works contract.
All right. I'm going to take this across to Harsh Mariwala because I think he had a larger big picture question on these GST rates and the review when we were talking at least before the show began. Mr. Mariwala?
How stable are these GST rates going to be in future, or are they going to be reviewed every year like you review the budget and the direct taxes and whatever changes are needed? We strongly believe that they should be stable for a long period of time and not be subject to yearly review as in a yearly budget. It's important to keep the rate stable for a long period of time.
Well, that's a good suggestion, and I think all taxes should be stable. Stability of tax policy is something which the industry loves most, and we are conscious of that fact. So unless our revenues go haywire and we need to do something about it, we also would love to stick to the rules. But ultimately, it is a decision of the GST Council.
So I have quick two last questions, and I'm going to take one on cinema goers. 28% is the rate. There are about 2.7 billion people who watch movies. Is this still a luxury service?
It's no, look, what again, please remember that when we looked at the existing rate of entertainment tax being levied by states on the cinema hall, it is ranging from 15% to 110%.
Oh my God, I didn't know
Yes,
that. 10%
yes,
basis.
it is very high in all the states. And that's why we have said that 28% is all we will take in GST because that's the maximum rate.
Right.
The remaining amount also the states are going to continue to charge because most of the states are planning because they have got a separate entry in constitution that they can levy extra entertainment tax duty for the benefit of local bodies, which the states are free to do. And so some of the states are planning to do that also. So in case of entry tax to cinema hall, certainly 28% is way lower compared to the existing incidence. So there is absolutely no question of anybody saying that it has gone up so much. No way.
Okay, a last question to you before I actually give it to Mr. Bhargav and Mr. Goenka to quickly take, and I'll let you go in 2 minutes here. Is the software classification resolved? Is it a good or a service?
Oh, of course. Now it is a supply. It's a supply. There is no distinction between goods and service now. It's a supply. So there is absolutely no classification issue in software.
And how exactly do you propose to handhold industry through this?
No, they understand it very well. Now software is a supply and all inputs, whether of goods or services going into software making, that will be subject to input tax credit. So the industry understands it very well now.
Okay, I'll hand it over to you to close this arguments very quickly. Your last questions to him and then he has to go.
Well, no, I have really no more questions to ask because my doubts have been clarified, and I think it has been clarified also that industry in the area of hybrid cars
That's right, yes.
is free now to make a representation, and I hope this will be considered by the Council before the 1st of July deadline.
Indeed.
Because otherwise, what I'm afraid of is that if this tax system is not reconsidered, we might just come to no hybrid cars happening in this country, and we lose out on all the technology development as well as the development of the components was taking place, like the lithium-ion batteries and such projects may not be implemented any further.
But I think you've already got your words of assurance from him. And on that note, Mr. Adhia, we really thank you for joining us right here on ET Now. This is the CEO Dialogue, and you've really clarified issues for Indian industry, issues that will creep up as we march towards the biggest tax reform independent India has seen. Thank you very much, sir. Thank you each one of you for being with us. We'll keep it with news and views right here on ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.